Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking miners traded in London, and my guest is Russ Mould, Investment Director at AJ Bell. The transition to clean energy was supposed to be a new gold rush for mining giants. Since copper is vital to manufacture electric cars and upgrade the electricity grid, nickel and cobalt are essential for batteries, and semiconductors need rare earth metals. As economic growth has weakened, though, especially in China, metals prices have sunk. Copper prices have fallen about 4% this year to below $8,000 a tonne there, from a peak of more than $10,000 last year, leading miners to warn that if prices don't rise, there won't be enough mines under development to keep pace with the energy transition. This is the FTSE 350 Industrials Metals Index, including giants Rio Tinto, Glencore, Anglo American and Antofagasta. It's down more than 16% year to date, and one of the FTSE's worst performers. Glencore and Rio Tinto are still among the index's top 10 dividend payers, though, and the price of gold is soaring amid concern about global instability. Well, for more, I'm joined now by Russ Mould, Investment Director at AJ Bell. Russ, hi, thanks for joining us. With the global economy still looking weak, are miners going to dig themselves out of this hole?
I think that there have been three things that have been weighing on the mining share prices this year. The first one you've already mentioned, which is disappointment with the pace of recovery in China and concerns over the overall health of the global economy, despite America continuing to surprise on the upside. The second is the stronger dollar. All industrial and precious metals are priced in dollars. So the higher the dollar goes, the more expensive it is for non-dollars to buy these things. And those two things have in turn then weighed upon metals prices, which mean we haven't had earnings upgrades, we've had earnings downgrades, and also some retrenchment in dividends and buybacks. So that's really what's been weighing on these firms. So what could go well for them? Dollar weakness would help, economic strength would help, and yes, ultimately, mining price strength would help. Though the other thing that to bear in mind is if we did get, say, a sustained burst of inflation, if you look back to the 1970s, what did well then? Real stuff, real assets, not paper ones, things that central banks couldn't print in effect, and that might again give investors another reason to look at metal producers and mines.
Do you think this is a sensible time to buy the dip here?
I've got to be careful what I say because we're not allowed to give advice, but I think if you're an investor who does think that central banks will perhaps take their chances with inflation, rather than push interest rates too far, given where government debt burdens are, given their fear of a recession, given that we can't really afford a deep recession, given those debt burdens, if that's your core view, then I think that would play to perhaps you looking at miners, particularly when they've been disappointing performers this year, and they do look potentially quite temptingly valued on even mid-cycle, let alone peak earnings basis.
We thought, Russ, that miners would see a bonanza on the switch to clean energy because so many of these metals, copper, nickel, cobalt, are essential, as I said. Why haven't we really seen it yet?
I think there's an element of, again, pace of expectation. I think, as we're seeing with oil, there's lots of hopes that we wouldn't be using as much oil and gas. And unfortunately, that hasn't been the case. We're still very reliant upon hydrocarbons. And I think therefore you're seeing that with these metals such as cobalt and lithium, that they're going to be incredibly important going forwards. It's the pace of adaptation and the cost of adaptation that's key. Equally, you can see miners are jockeying for position. There was a big takeover bid for a lithium producer in Australia, Liontown Resources. I know that's now been scuppered by Gina Reinhart sticking a roar in and buying a 20% stake. But miners are looking for positions here. They are looking for angles. And I think over time, those things will come out to play.
What about precious metals, Russ? We're seeing another spike in gold over the last few days on the back of all this global uncertainty. What about the gold miners?
Yeah, it's the one thing we never really want to see performing well, gold, because it means something's probably going quite badly wrong somewhere else. There's been lots of merger and acquisition activity in gold over the last 2 or 3 years. So again, they've been positioning themselves for a stronger market. I think Yamana Gold was the last one to be taken over by Agnico Eagle and Pan American Silver. But again, haven assets as much as anything else. And at the moment, the American economy hasn't disappointed. We got a bit of a wobble in the American banking system in spring. There hasn't been yet that major catalyst for people to seek out very fundamental havens. Unfortunately, perhaps the Middle Eastern war may be one of them, and that's been giving gold a bit of a lift recently. But at the moment, at least, you're not seeing sustained inflation. You're not seeing a return to central bank money printing, and you haven't got that sort of major disasters. That's probably what's kept gold back in its box this year. So again, if any of those do happen, that's maybe when gold will start to perform.
Traditionally, Russ, the FTSE mining giants are big dividend payers. What about this year for their shareholders? And presumably some of them are a better position than others at the moment.
Yeah, I mean, they run quite firm payout ratios. So if earnings go down, dividends go down, and if earnings go up, dividends go up. So they're pretty methodical about that. So we are seeing a pullback from very high levels in dividends. They're still forecast to represent something like a seventh of FTSE 100 earnings and dividends in 2023. That figure's been high as a quarter. So again, it shows you what could happen if metal prices really start to motor again. And yeah, Dr. Copper, the old economic health indicator. So if you did see a stronger world economy, you'd expect that to filter through. I mean, Rio Tinto is basically you play on iron ore right now, Antofagasta on copper. So they're pretty simple companies to understand in some ways. So metal price strength would feed quickly through to dividends, and that's something that income investors might like to consider going forwards.
Russ Mould, Investment Director at AJ Bell, thank you so much for joining us.
Thank you.
And that's your roundup of the mining sector. I'm Elena Casas, and this is Reuters.